Hello, and welcome to another episode of Transforming Business with me, Marvin Schneider, where I talk about everything business transformation, but not generic business transformation that a lot of the mainstream consulting firms will talk about. The kind of business transformation I'm talking about is the fundamental, from boardroom down to shop floor, adjustments required for corporations all over the world to create wealth in a sustainable, ongoing way and in ways that enhance the well-being of the individual, the wider community, and the environment. And this is a way bigger agenda than generic ESG actions, and it's even way broader than typical mainstream consulting firms are talking about. So, in a number of previous episodes, I've spoken about some of the more softer, intangible sides of the transformation agenda. I think the second episode of the podcast series was geared towards the need for business leaders to operate out of, higher consciousness. And it had this notion that we as humans are spiritual beings having a human experience for the purposes of adding to and expanding universal consciousness. And so once you kind of understand that, then the idea of a lot of primal human behavior that is exhibited in business through fear, greed, power, control structures just doesn't work. And so if we're going to solve this problem where business is fundamentally a force for good in society and for humanity, then you definitely need to address the issue and the solution from a higher vantage point and a position of higher consciousness, because you really cannot solve a problem with the same thinking process that created the problem in the first place. So that was what that episode was all about. I'd encourage you to go onto my YouTube channel, Valuation Insights, and you can find a playlist. But I think that was the second episode in the series. And then I did another episode recently on the new business paradigm, which is 100% geared towards the primary purpose of business is to create products and services and produce them and distribute them for the fundamental benefit of society, the individual, the wider community, and the environment. And in that episode, I talked about the old paradigm being the shareholder primacy paradigm being fundamentally broken and leading to really poor outcomes for the individual, the wider community, and the environment. And then we talked a little bit about the role of the board in defining a purpose grounded in a noble intent to do good in society, and where everything else that comes from it, including the creation of profit, the reflection of that in wealth, is a result of putting into the market products and services that are truly beneficial for those that consume them, and it enhances the well-being of the individual, the wider community, and the environment in the activities of the business in producing and then distributing those products and services. And that idea is fundamentally more expansive than traditional ESG thinking. And even shared value back in the day, 10, 15 years ago when shared value came out, I was always skeptical about the expansiveness of the shared value agenda. It always struck me as it was a bit of an afterthought, right? So we're going to continue along in the old business paradigm, but oh, by the way, we might throw, a little bit of money towards sort of, more sort of social outcomes. And to me, that's sort of putting the cart before the horse, right? So you need to get these linkages clearer. And so the outcomes for shareholders and therefore the primary governance purpose of the board is to set the corporation, set the conditions necessary for long-term success based on creating, producing, distributing products and services that truly benefit the individual, the wider community, and the environment. And everything else is an outcome of succeeding in that endeavor. It's a fundamentally different paradigm. I know it's broad-based and expansive in its nature, but that's what we're dealing with. So in today's episode, I'm going to start shifting gears a little bit and dealing with some of the more the hard sciences of corporate finance, the notion, and particularly in this episode, I'm going to be talking about valuation, because valuation is a stepping stone to wealth creation. And not a lot of people understand the distinction between value and wealth creation. And so very quickly, value is a measure at a point in time as to the worth of the company based on its strategy and its operations and what it is doing and the likelihood of success in doing that. And there is a value today, there is a value yesterday, and there will be a value tomorrow. And those valuation outcomes are a reflection of what the organization is doing, how it is doing it, and how successful it is likely to continue to do that, given market conditions, the forces of competition, those kinds of things. Now, I should also say that I've spent about 20, 25, close to 30 years deeply embedded within the corporate finance linkage to strategy valuation sphere. And so I operate with these concepts on a daily basis. Now, I understand there are a lot of other valuation experts out there. Pretty much all of the mainstream accounting firms, the big four accounting firms, will have a valuation practice. And in a past life, when I was operating a company with a colleague of mine, as independent valuation experts, quite often we'd come up against the other accounting firms and their valuation practices in a contestation around valuation, generally for tax reasons. That was the nature of that business that I was operating for close to 10 years. Thankfully, I've stopped doing that because there are way more important things to do, in my view. So I want to talk about, and when I'm talking about valuation, I'm talking about the intrinsic value, not the observed value. But it's important to understand how the observed value, as reflected in a share price, is either consistent or inconsistent with the intrinsic value, because that's really important information. So I'm talking about intrinsic valuations. One of my biggest bugbears is that there is still, unfortunately, so many people operating and providing opinions on valuation based on simple metrics and comparables, PE multiples and earnings ratios, those kinds of ratios. And the fundamental problem with that is that those valuation techniques are primarily grounded in share price outcomes, which may or may not be a reflection of intrinsic value. Now, I understand that if you're buying or selling a company, like if you're buying and selling a house, then you will be acutely interested in what other companies of a similar nature are selling for. But that doesn't mean that it's a fair reflection of the value of your company, because fundamentally, as much as a lot of valuation people like to sort of put together broad-based comparables and then draw average, P ratios and apply that to this company on the premise that that's the best indicator of the value today. Those ideas are fundamentally problematic, and particularly when the purpose of the valuation is to understand the impact or the implications for the board and the executive team, and to be honest, long-term holding institutional investors. This is really not a useful approach. So I'd like to bring the listener back to the idea that the fundamental or intrinsic value of a company is, well, intrinsically linked to their strategy, and that strategy has consequence for cash flows go into the future, which you can then discount at a discount rate to assess the value of the company under this strategy at this point in time. And so a lot of people that are listening to this will recognize that that valuation approach is often described as the discounted cash flow valuation approach, or DCF valuation approach. And so fundamentally, the technique is think about the strategy, think about the market that the company is operating in, think about the forces of competition, make a forecast of revenue, costs, and capital between now and a long time into the future. That will give you a forecast of cash flows to shareholders, equity cash flows, which you can then discount at the cost of equity to get an estimate of the fundamental or intrinsic value of the company's equity at this point in time under this strategy, under the assumptions made that led to those cash flow forecasts. So at that level, it's a fairly simple idea. It's not a new idea. It's been around for at least 40, 50 years. And the linkage between cash flows, valuation, and strategy was one of the primary things that my consulting firm that I first cut my teeth in, called Maricon, it's a US-based consulting firm, top tier. They kind of, I'm not sure if they invented it, but they certainly popularized the notion that there is an intrinsic link between strategy, financial outcomes within a market, and the valuation of the firm. And the idea is that once you know the valuation of the firm under the current strategy, the idea is, can I conceive of an alternative strategy which will give rise to a higher set of cash flows over time that will enhance the value of the company? And that's kind of, in my view, what boards ought to be kind of fundamentally thinking about. There is a nuance and twist to that, which I'll kind of get to either in this episode or in future episodes. All right, so that's the fundamentals of discounted cash flow valuation. I hope most people that are on this, listening to this episode, and certainly I would certainly hope that every board member and every senior executive in every large corporation, and fundamentally listed large corporations, are at least intuitively familiar with this fundamental valuation technique. Because if they're not, I'm going to make a bold suggestion to every board member, every senior executive: please arm yourself with that understanding. Because if you don't have that understanding, I really don't know how you can govern and execute in the interests of the company at large without a fundamental understanding of corporate finance. Now, I'm a corporate finance expert, so I can certainly help in briefing boards and executives on these things so that they can start incorporating these ideas into their daily kind of activities. So if you have that need, please get in contact with me. All of my contact details are readily available. It's not hard to find out how to get in contact with me. Okay. I'd like to introduce you now to the corollary of the discounted cash flow valuation technique, and that is the discounted economic profit valuation technique. And fundamentally, these are not two different techniques. They are two sides of the same coin, but there's a whole lot of benefit in thinking about forecasting economic profit streams, discounting those to get an understanding of valuation. It is not a different valuation technique. Trust me, I've been working on this for 30 years. At that point, I'm going to invite you to entertain the possibility that I know what I'm talking about. But it's really important that people are familiar with the idea of economic profit and how economic profit links to value. So as I go through this, let me just bear with me while I'm going to share a couple of screens and take you through a couple of slides just to help as talking points. So let me do this. Okay, so the first thing that needs to be done is I need to define what economic profit is. And so this chart in front of you is showing economic profit. So economic profit is constructed from a P&L and a balance sheet. So the P&L side is all of the flows of revenues and costs leading to ultimately profit after tax in the income statement over a period of time, typically 1 year, 6 months, sometimes even quarterly. And then on this slide, the yellow aspects are key elements of a balance sheet, which is basically a stock reflection of the value of various assets and how they are funded. So we've got an income statement, and we've got an opening balance sheet and a closing balance sheet. And from those things, we can construct a series of metrics, including return on equity, which is basically just profit after tax divided by the opening equity. And it's important that it's the opening equity, the opening period equity, that will give you return on equity. And if I deduct from, and in this case, that's 20%. If I deduct from that return on equity the cost of equity, which I'm going to get to in a second, let's just assume for now that's 10%, then there is a measure called economic profitability, which is return on equity minus the cost of equity. That's 10%. And when you multiply that by the opening equity, you're going to get an economic profit of $20 million. So economic profit is simply profit after tax minus a charge for the equity that's invested that underpinned that profit. Hopefully that is simple. This concept of economic profit is not new. It's been in operation and well understood within the corporate finance community for at least 40, 50 years. But it's really important that economic profit has a more mainstream role in large corporates. So then let me flick to the next idea. That is, we do need to talk about the cost of equity. So on the left-hand side of this chart, there's the elements of the balance sheet, right? So there is a buildup of assets, in this case totaling $1 million. And that $1 million asset base is funded by 3 forms of funding: debt, which is the green bit in the middle. And most people are familiar with the idea that debt has a cost of debt. You need to pay back your debt funders for providing debt funding, and that's called interest. And there is a cost of debt. I think every person on the planet will be familiar with that. But then equally, there is equity, which is the funds or the undistributed funds provided by or not distributed to shareholders. And that's the blue bit funding in this build-up. And there is a cost of equity. Not everyone is familiar with the cost of equity, but there is a cost of equity. It is not a free form of funding. Shareholders do require a return for providing capital to the company. It's one of the fundamentals of, this form of capitalism. And then there is another form of funding called non-interest-bearing liabilities. It's a free form of funding, and the classic example of that is creditors or prepayments. as well, which is in a lot of ways another form of creditors. Okay, so that's the build up of the balance sheet. There is a cost of equity. There's a whole lot of people that get really bogged down into the minutiae of estimating the cost of equity. I would recommend that people don't get so bogged down into it. At this point, it's really important to understand that there is a cost of equity, and there are two primary components to it. One is the risk-free rate, which is the blue curve on the right-hand side, and the other is a risk-adjusted element, and it has two elements, a thing called beta and the market risk premium. I wouldn't get too hung up about it, but just think about it. There is a risk-free element to the cost of equity, and then there is another element reflecting the risk of the company, because higher risk companies or shareholders in higher risk companies legitimately expect and demand a higher return in order to invest in those stocks. And so when you add those components, you get the orange line, which is the cost of equity for the market as a whole. And the important thing here is that it varies over time. And let's just say that in the early 1980s, the cost of equity was very high. And most people will understand that through the course of the global financial crisis and then now sort of COVID and various other things, the cost of equity is quite low, but is trending up. That's about what we need to say about that. So the next thing that I'd like to introduce you to is the notion of valuing a company based on a forecast of economic profit linked to strategy. So on the left-hand side of this chart, we are going to value a company as at 2021. And so there's two things that you need to do in order to estimate the intrinsic value in a way that is fundamentally linked to strategy. So the first thing is it is important to understand the elements or the strategic position that the company is in today, which is in this example 2021. But this company has an intent to move from the current strategy to an alternative strategy. And so there is an expectation that as a result of that shift in strategy, the strategic position will improve between 2021 and 2026. Now let's go to the right-hand side of this chart. On the left-hand side, the thing that's in white, we are plotting the economic profit actually delivered through historical performance over the 10 years prior to today, which is T0, which is 2021. And that's what the sort of element of the blue line is in this section entitled Historical Performance. Then there is an explicit forecast of expected economic profits as a result of the shift in strategic position over the period 2021 to 2026 and even 2031. And so that's what is the forecast in economic profit in the forecast horizon period. Now you're going to notice straight away that this valuation is based on the premise that there would be a significant improvement in economic profit performance relative to what's happened in the past. The next really important thing is what are the expectations beyond the forecast horizon. And you're going to notice here that I've built up a forecast horizon of 10 years. And I think it's quite useful for people to think about long-term forecast horizons. And I'll get to that a little bit later, hopefully, if I don't forget. So a significant part of the valuation is embedded in the parts of the future beyond the current forecast horizon. And that's what I call the convergence horizon. And so the premise here is that the forces of competition will erode returns and growth to the point of sustainable levels over a period of time, such that at the end of that convergence horizon, economic profits are zero. Now, that doesn't mean that accounting profits are zero. It means economic profit is zero, which means that you are earning in an earnings sense what shareholders expect. And then in economics, a positive economic profit stream is often described as super profits. And so the thing is that in a stable, steady state, competitive environment, all of the participants in the market should be earning economic profits of about zero. So that is the benchmark level of performance. And then that then creates an economic profit stream, between 2021 and every year in the future. And then when that is discounted, it gives you the value created, which is the green bar in the middle. And when you add that to the opening balance sheet, the opening book equity, the sum of those two things equals the intrinsic value, which is the gold bar. That's how an economic profit valuation works. And what's really important about this is that it allows you to bound the valuation in an economic understanding of how the forces of competition will erode returns and growth back down to sustainable levels. And this is really important because a lot of traditional valuation approaches have a bit of a tendency to have an open-ended terminal value. And it's really problematic because there is a high risk of leading to overvaluation estimates, which is clearly not a good thing. So let me just quickly describe this to you. The notion that the forces of competition drive returns and growth down to sustainable levels. So in the forecast horizon, the traditional idea of strategy is to create strategic advantage, which will allow you to achieve a higher level of returns and growth than is what is expected, in the long term. So you've got some kind of advantage that allows you to have positive economic profit streams and fairly high levels of growth. And so the idea is that you forecast the returns over the forecast horizon and the level of growth over the forecast horizon. But then after that, the safest assumption is that the forces of competition will act in such a way as to erode returns, which is economic profitability, back down to zero, which is the benchmark expected level of economic profitability in a perfectly competitive market. And it will erode growth back down to long-run expected economic growth, which a lot of valuation experts assume to be about 2.5%, which is basically zero real growth, but 2.5% long-term inflation. So the nominal growth is 2.5%. So that's how that works. And then you can reflect that into an economic profitability stream, converging down to zero over the convergence horizon, a level of growth that allows you to forecast the book equity invested in the business. And that then derives an economic profit stream, which when discounted gives you value created. When you add that to the opening book equity, it gives you an assessment of the intrinsic value of the firm. Now, the important thing in doing all of this is to assess the length of the convergence horizon. And unfortunately, at this point, there is no empirical evidence that we can bring to bear that will allow us to, fully and, know what the convergence horizon is. But it's really important that valuers, in any fundamental sense, put an argument together as to how this strategy in this market will lead to either a long convergence horizon or a short convergence horizon. And this is the convergence horizon. Let me just go back to a slide. The convergence horizon is the length of time over which returns and growth remain above sustainable levels. So it's the amount of time beyond the explicit forecast horizon. I typically use a forecast horizon of 10 years. And so in this scenario here, I've reflected a convergence horizon of a further 15 years. My view is that that's about right for the majority of the companies out there. So that's how you can use this technique to link strategy to a forecast of economic profits to assess the intrinsic value of the firm. And it's really important information. But I can equally use these mechanics to look at the share price of a firm and estimate or reflect what the share price means in terms of the kinds of economic profit required to be delivered to justify that share price. So this chart here is an example of CSL, which is one of the very admired Australian companies, and this is reflecting the economic profits required to be delivered in order to justify the share price of CSL as at 30th June 2020. So it's a little bit old, and the reason why I'm using old case studies is because I'm not trying to create any sort of valuation now kind of things. It's not the point of this. So back in 30th of June 2020, the market value of equity of CSL was 130 billion odd dollars. And in Australian terms, that's a pretty big market cap for an Australian company. The book equity invested was just a little bit less than $8 billion. And so what that means is that there is an excess of value to the tune of $122 billion embedded in the market value of CSL in excess of the amount of money that shareholders have invested in it. And that's a lot. The ratio of the market value to the book value is really, really high, which means that this green bar is really high relative to the amount of book equity invested in the business. Now, the only way that that can be true in any fundamental sense is that the level of economic profit to be delivered is really, really high. So let me just put a little bit of context to this. This part of the blue curve reflects the economic profit that has been delivered by CSL over the historical period 2010 to 2020. Now, delivering, in a growing economic profit stream almost year on year, leading up to, $2.5 to $3 billion represents an exceptional level of performance. And so CSL is always regarded as the poster child, company, successful companies. And I take nothing away from them whatsoever. They clearly do amazing things and they've delivered amazing financial results, and they've created a lot of wealth for shareholders, particularly those that invested in CSL in the earlier days and took the ride all the way up to where we are today. So this line here is the historical performance, which is clearly excellent. Now, starting from the share price in 2020, though, the level of economic profit performance needs to almost instantaneously double, then continue to rise up to about $7 billion. And then even in the convergence horizon, because the level of growth required to justify the share price is so high that it will continue to rise up to about $10 billion before the forces of competition, the dynamics between returns and growth, finally turn the economic profit stream, from an apex, and then finally drive down to zero, to justify this $130 billion of value. So this is using discounted economic profit valuation approaches, using some fairly clever maths and technology that I've developed over a wee while, that will allow us to disaggregate a share price for any company at any point in time into the economic profit requirements to be delivered into the future, and allows you to assess that relative to what's been delivered in the past. Now, the reason why this is really important is because someone that looks at this chart can ask the obvious question, which is it possible that CSL's share strategy in 2020 has any hope of delivering these economic profit outcomes? And if the answer is yes, then the intrinsic value of the company is aligned with the market value of the company, and you might be happy to invest in CSL and expect to justify its market value. And that's fine. That doesn't mean that you're going to create a lot of wealth. In fact, what it does say is that you will break even from a wealth creation sense if you invest in 2020, having answered the question that, yes, this is an achievable economic profit stream, and therefore I'm willing to invest. If you look at this chart and say, I don't think CSL's current strategy in the current market has any hope of delivering these kind of outcomes, effectively what you're saying is that you believe that CSL's $130 billion back in 2020 was overvalued. Now, investing is an art and a science, right? So we're going to talk about the investment side of things in future podcast episodes. But what I want to introduce to you today is the notion of valuation, and valuation linked to strategy, and valuation as reflected in an economic profit stream, because this is going to be a building block for everything else that we're going to talk about on this podcast series. So it is important. There's only one more slide that I want to show you, and that is this one here. Let me explain it to you. I have created the technology that allows me to build a fairly large-scale database of any listed company anywhere in the world over any time period. And so what I've constructed here is the aggregate of the top 50 non-resource, non-financial services companies in Australia as at 30th of June 2020. All right. So I've picked the top 50 non-resource, non-finance companies. I've added them together to create an aggregation, so that think about this aggregation as operating as a portfolio of these 50 companies. And then we're treating them as if they were one entity, but they're really a portfolio. And so they're going to have a portfolio of delivered economic profit streams. That's this blue line here. There is going to be an aggregate market value, and therefore I can assess the aggregate level of economic profit that's required to be delivered in order to justify the aggregate market value. So I want to share with you a couple of thoughts on this and what it means to me. So these top 50 companies, and these are the top 50 companies in Australia, they have delivered over the prior 10 years, prior to 2020, for a reasonable chunk of the time, a declining economic profit stream, declining to the point where the aggregate economic profit in about 2016 was about zero. Now, a zero economic profit stream is actually what economists would say you would expect within a perfectly competitive market. So basically, we were in a declining economic profit environment, but since then, post the recovery of the GFC, economic profit delivered started to rise again, as companies readjusted to the new environment. Okay, that's fine. This decline in economic profit stream is a little bit concerning because this is what's delivered. There's no, there's no funny money here. This is what's actually been delivered. And then there's been a bit of a rise. But here's the thing. From this point forward, there needs to be such a big jump and such a continued rise in an economic profit stream up until an apex, some 40 years into the future before the forces of competition will drive these things down over a convergence horizon of 60 years. 50 years. Now, the reason why I picked 50 years in order to construct this is because the present value of an declining economic profit stream in 50 years' time is getting pretty close to zero. And so it's about as long as you could possibly reflect. And so even though the convergence horizon that I've used to construct this chart is really, really long, nevertheless, the required economic profit stream is so high that I am concerned that there is a real overvaluation risk and in the market. And this is in 2020, by the way. A lot of the primary stock market indices, even today, even within the midst of COVID, and yes, I know it's kind of come down a little bit, but it's rising again, is higher than what it was back then in 2020. So this ought to be a little bit concerning. And I know that there are a number of people that comment on, a point of view that a lot of companies on a lot of stock markets around the world are overvalued. This is a great technology or tool to make that assessment, because you look at this and it forces you to ask the question, what are the odds? What are the chances? What is the possibility of, either a company, or in this case, an aggregation of 50 companies delivering these outcomes? Because the practical reality is that as soon as the market realizes that this is unachievable, you would expect there to be a correction. And when there is a correction, then a whole bunch of people that have invested or put money in around 2020 at these high valuation prices will have a high risk of destroying wealth. So let me stop sharing for the moment and then just kind of wind down this episode nice and slowly. So hopefully this will give you a good understanding of the corporate finance underpinnings, and particularly the way that I've put them together to underpin all of the transformation thinking, frameworks, tools, digital assets, to transform the business and investment communities in ways that create wealth, or to create wealth in ways that enhance the well-being of the individual, the wider community, and the environment. I'm going to talk in probably the next podcast. I want to start talking a little bit about capital markets at the moment and how share prices are so volatile and potentially overshooting and undershooting intrinsic value, the risks of that, why they exist, and what needs to happen to bring things back into alignment. But my primary contention at the moment is that the way that the capital markets operate at the moment is really problematic. It is risky. There are numerous bubbles created. Those bubbles burst, and it is the institutional shareholders that are investing trillions of dollars, pounds, euros, on behalf of retirees, superannuants, basically intergenerational shareholders. They ought to be really concerned with the way that capital markets operate, and it needs to change. And I think in the next episode, I'm going to talk about some of those things just to give people an idea of how insidious and problematic the behavior of the capital markets is. And let me just end this podcast episode with this question. Why is it that all of the major stock market indices are higher today in the midst of COVID? COVID's not over. And with so much geopolitical instability, higher today than it was back in June 2020, where even the evidence might suggest that even back in June 2020, there was a significant overvaluation risk. Why does that persist today? And why is it even potentially worse today? And what should be done about that? What should institutional investors do about that? Should they care? I've got my own views. Please comment and on the video, and let me know your thoughts. In a lot of ways, it's not that important what the answer is, as long as people begin to recognize that, Houston, we've got a problem, or there is a problem, I think was technically what the quote was. Once there's a recognition that we're in dangerous territory, then at least we can start addressing the issue. But if you're operating within an environment that there's nothing to see here, it's all good, let's keep going, then we're never going to achieve anything. So thanks for tuning in. This one was a little bit longer than I usually do. We'll keep it shorter going forward. Please subscribe to my YouTube channel on YouTube called Valuation Insights. And this podcast series is called Transforming Business. I hope you're enjoying it. I hope it stimulates you to think about things, and particularly if you're in a position of influence. So, boards, chairs of boards, CEOs, senior executives, please get in contact with me. There's a lot that I can help you with. We need to get moving. We don't have a whole lot of time. It's even more important. Well, it's as important as the whole climate change thing, but we're addressing the business and investment community in a holistic, fundamental way. And climate change and positive climate change outcomes will be one of the benefits of moving forward on the agenda that I'm describing. That's how important it is. Please get in contact with me. Don't sit on the fence. Thanks for watching, and bye for now.